want to welcome all of you guys to today's session. So, as I've told you guys, we're having a lot of things cooking in the background. We're having a boot camp coming in. So, for the new guys here, we have two classes. We have the beginner classes and advanced classes. The beginner classes are always there at 10 a.m. Ugandan time, and the advanced classes are always there at 7:30 p.m. to 9:30. And we always break down a trade and we discuss insights also. But then in the forthcoming bootcamp, we're always going to have live trading sessions with you guys, so at least you can make money with us. And I would like to also share with you guys a broker that I know that works so well. So I'll share you the link later on, but let's first focus here. So I'm going to discuss for you guys how I took a trade from here. There was a setup here on Nasdaq. So, but let's go to today's session. All right. So, are all you guys seeing this? Are you guys seeing that? Are you seeing it? Yes. Are you guys seeing the chat above? Yes. You're seeing it. You're not seeing it. Okay, let me try to set it again. Are you seeing that chat now? You're seeing that chat?
Yes.
Yeah. So this is what we're going to talk about today. So if you're new here and you want my number, my WhatsApp number is there. So this is the trading chatter, and I present here alongside Mr. Willie. So we present together, and today we are going to have sorry. So today this is what we're going to talk about, right? So this is what we are going to talk about today at the trading chatter. We're going to talk about elements of a trade setup. It's a lecture I'm repeating for those guys that never understood it. And there's a lot to eat. There's literally a lot to eat that we can't condense in one day. So I'm also going to continue with it. We shall continue with it in the boot camp. Yeah, furthermore. So we shall break down now each and everything well and precisely. So today we are going to talk about elements of a trade setup, of actually an A+ setup. So we say that as you want to make your trade setup, you want to focus on what? 3 things. 1, 2, 3 things. And they're all crucial in the trading space or the trading setup that you're going to like form. So number 1 is you need to have the trend. And we all know that in trading, they always tell you guys that make sure that the trend is what? Your friend. Always make sure that the trend is your friend, right? So under the elements of an A+ setup, we have trend. That's number 1, trend. Then number 2 is we have support and resistance. Then number 3, we have risk management. So now let me explain each of them. I need you guys to get a pen and a paper right now. Get a pen and a paper and write this down because it's going to help you in your trading setup. It is going to help you to formulate trading setups every day. So get a pen and a paper and try to mark these things out. Alright, so number one is we have the elements of a trade setup. Number one is trend. Number two is support and resistance. Number three is risk management. So now, if you understand all of these, they all vary. They all vary in different ways. How do they vary? They vary because each of the elements that you see there are determined by something and define something. When you talk of trend, now let us focus on the trend. There's two things with trend. Trend literally means direction. It means direction in trading. So when we talk about trend, what has to come into your head has to be what? Direction. Which direction is the market expected to go, or which direction is the market anticipating to deliver price? Now that's the trend we are talking about. So when we talk about trend, we have two trends. We have a bullish trend and a bearish trend. So now let me explain the bullish trend first. I need you guys to get a pen and a paper and write this down. So for a bullish trend, what we are talking about is a trend that is going up, literally. It is a trend that is simultaneously going up. You understand? It is going up. You can call it an uptrend. You can call it a bullish trend. You understand? Literally, the market is moving in a zigzag way but going up. So we are talking about trend. So let me show you an example. Let me come and show you an example of trend. Let me come and show you an example of trend. So this is going to be our trend. We are talking about trend, and we've talked about the bullish trend. And what have I said about bullish? I've said that bullish is when the market is going up. You understand? So bullish comes from the word bull, and a bull, we all know what a bull is. A bull is an animal that when it's fighting, it tries to push its horns in the upwards direction. So that's why they picked the nickname for the market, bullish. So bullish is trying to signify that the market is going up aggressively, and that is picked from the bull on how it fights. So let me show you. So bullish market is going to be like this. We go up, we come down, 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 we go up, we come down. So now this is a bullish trend. Are all of you guys seeing it? Is everyone seeing the chart? Yes, you can give me a thumbs up if all of you guys are seeing the chart. Alright. Okay. That's great. So everybody's seeing the chart, right? So now that's the bullish trend. So this is a bullish trend, and it signifies that price is going where? Up in a bullish direction. So you can see it. You can do that by putting the trend line. Then also up here, we put a trend line to tell us or to signify to us that market is going in a bullish trend. So that is our trend line. Yeah, though sometimes price won't tap there in a sequential way, but then at least we'll have points that will tap. So now that's our bullish market, right? So let us label it here. So this is our bullish market. So as I've told you guys, Bullish comes from the word bull, and the bull fights while sticking its horns up. So that's why they nicknamed, or that's why they nicknamed an uptrend a bullish trend. So now I hope you guys have understood this. This is very simple. So now after the bullish trend, what do we have next? We have something called the bearish trend. So the bearish trend is literally the opposite of this. So bearish is the opposite of bullish, and bearish comes from the word bear. And how does the bear fight? The bear fights while taking its head down or pumping its claws down. You understand? And that's how the bear fights or attacks. And then if you look at also the bearish market or the down market, when it's going down, it goes down aggressively, just like the bears. And that's how they nicknamed it a bear market. So let us do its representation too. And that's why they nicknamed it a bear market. So literally, let me do its representation too. Let me do its representation. So it's going to be like this. So this one here is going to be a bear market, bearish market. Down, up, down, up, down, up, down, up, down. So now that's our bearish market. And now this market is a down market. You understand? It is going down. Price is being pushed down. Price is getting pushed down. Just like that. So price will touch there. So this is a bearish market. So we label it bearish. Let's make this guy touch here. So we label it bearish. Bearish market. Alright, it's there. So that's our bearish market. This one is our bullish market. This is the bearish market. So these are the two examples of trend. Has everybody seen them? I told you guys to get a book and a paper and label them because they are going to be essential in the forthcoming lectures. So now that this is the bullish trend, the first one, this is the bullish trend. This one is the bullish trend here, then this one is the bearish trend. So now let's pull over. I hope all you guys have understood trend, right? So now the next aspect after trend is what? Support and resistance. So as I've told you guys, we are going to go in a chronological way. So after trend, we are going to support and resistance. So literally, for support and resistance, there are two things. I want to break down support and resistance like this, right? I want to break down support and resistance like this. Let's assume that, okay, the logical way to understand support and resistance is this, right? Support means that you're supported by something. Maybe you're falling down, then you fall on something. Then resistance means that there's something pushing you down, right? So we are going to do this. We are going to take our support to be as the flow. Our support is going to be the flow. Then our resistance is going to be the what? The ceiling. So that's going to be it. So we are going to take that as an example. So if you're on the floor and you try to jump up, what happens? What happens? If you're on the floor and you try to jump up to the ceiling, what happens?
You know the ceiling and fall down.
Yes. Alright, so when you jump from the floor to the ceiling, you're going to knock the ceiling or hit the ceiling. But then that ceiling is going to act as resistance to push you down. And one of the factors that you're going to come down is what? Gravity, isn't it? So that means that the ceiling is acting as what? Resistance. Well, meanwhile, when you come back and fall down, where do you land? You land on the floor. You land on the floor, and this floor is acting as what? Support. Yes, exactly. So now that's the logical way to understand support and resistance. So for example, in this bearish market here that we've labeled, this is going to be our what? Support. It's going to be our what? Resistance. Support down here, resistance. So this guy jumped up to the ceiling, they pushed him down. He got support from here on the floor. He jumped up back, they pushed him back down, gained support from the floor. He jumped up back to the ceiling. I hope you guys are now understanding how it flows, right? Yes. So now that is literally the logical way of putting together support and resistance in a normal way. You understand? So that is support and resistance. The third aspect is, as we are talking still about support and resistance, we are going to use order blocks and fair value gaps to act as what? As our support and resistance. Do all of us know fair value gaps and order blocks? Yes? Do all of us? Yes? Do all of us know fair value gaps and order blocks?
Yes. Somehow, no, but
Okay. So we are going to talk about them in a minute. We are going to talk about them. So now, our support and resistance, we are going to use two things. We are going to use order blocks and fair value gaps, right? So the third thing, or the third aspect to the element of an A+ setup is what? Risk management. And I told you guys that risk management is crucial. Risk management is very crucial. Who knows something about risk management here? What is risk management? So risk management is actually a way that you could calculate the amount of money that you want to lose in order for you to gain. Risk management is the management of your funds in a way that you're going to know how much money you're going to risk to gain something. And that's how it works. So it is a great aspect to trading, right? So we have many types of risk management and many examples. So we have 1, 2, we have something that is called a risk to reward ratio. We have something that is called a risk to reward ratio, and that is literally telling you that how much money are you trying to risk in order for you to gain. You understand?
Yes.
So a risk to reward ratio is going to stipulate very well how much money you're going to risk on a trade to gain how much money. So for example, the risk to reward ratios that we have 1 to 2, we have 1 to 1, we have 1 to 3, 1 to 5, 1 to 10. You understand? I think you guys are understanding that, right?
Yes.
Alright, so the point is that if you're going to risk $1, you have to risk $1 and know how much you're going to gain. Or else we are just gambling. Before taking up anything in trading, you have to know what is on the other side. So for example, if at all I'm going to risk $1 to make $3, does that make sense? If at all I'm going to risk $1 to make $3, does that make sense? I hope that makes sense, right? So risk management is very crucial and important in a way that you know how much money you're going to risk in order for you to gain. And you also stipulated very well the amount of money that you're going to gain if at all you've risked something in particular. So that is the third aspect, 2 elements of an A+ trade setup. So for the new guys here, we have 2 sessions. You're most welcome to the trading chatter. So we have 2 sessions of classes. We have the morning class, which is for beginners, that starts at 10 a.m. every day, except for Sundays. Then we also have another class that starts at 7:30 p.m. That's for the advanced. So we always talk about these things, but then today you can attend here because the same things that we teach that side are the same things that we've taught here this week, at least. So now, the point is, you need to understand that before taking a trade, you have to have these 3 aspects, or these 3 elements of your trade setup. You must know the trend well stipulated, you must know the support and resistance levels, and then you must know finally your what? Your risk management. Have you understood? Have you understood? So that is it. Yes, you've understood, right?
Yeah.
So that is it. And now, the golden gem here is, get it? Where is it? So I made some, let me first increase this. My chart is a little bit messed, but shall be fine. Shall be fine. So this is our bullish trend. I think I can delete them. I'm done with explaining them. They're just many lines, but then you have to make sure that you master these things. very well. The trend, master it, because you want to flow in the same direction to which the market is flowing. If the river is flowing going to the south, you also want to be flowing going to the what? To the south, right? You don't want to be opposing it. When you oppose it, negativity happens, and you don't want to be there, right? So now, this is it. This is it. So yeah, now the fair value gap and the order block, right? So let me explain to you what the fair value gap is, right? So a fair value gap is literally a three candle formation pattern in which the first candle's wick and the last candle's wick create lines that leave an inefficiency in the third candle. What I'm trying to say is this. There's an example here. I think you can see this, right? I hope you can see this. So if this is an order block, right? So an order block is literally the last candle that is going in the opposite direction that pushes down price. For example, this candle here is a bullish candle, right? In this case, the gray candles are bullish, or they are going up, while the orange candles are going down, right? So this gray candle is literally signifying what? Buying, right? So an order block forms when a candle going in a stipulated direction is the last candle to deliver in that direction. Then what comes after it? There's an opposite drive in price that comes after this candle. Now this last candle that is formed is our order block. I hope you guys have understood that. Like the last candle that forms before an opposite move in the market forms for us an order block. Have you guys understood that?
No, pardon.
I've said an order block is the opposite candle, is the last candle that is opposite before another. Okay, this is it. I think this candle here, it is what? Bullish, isn't it? This candle is signifying buying.
Yeah.
Then the orange candles are signifying selling. So an order block forms with the last candle that was going in the opposite direction before price changed. So this candle was buying. So there are multiple candles that might have been here that were buying, but then here it was the last bullish candle to give us a sell side move. You understand? Right? Have you guys understood this?
Yeah, I think
So that's another block. It is the opposite candle that gives us opposite movement. It's the last opposite candle that has caused the opposite movement. So for example, in this drive down, which one is the order block? This candle here. Because it's the last candle in this movement of selling that caused for us this buying what? That caused for us this buying. You understand? Please, you mute. There's someone with noise in his background. Alright, so this is it. Like in this case here down, this last candle here is the what? This last candle here is the what? The order block, right? This orange one, because it is the last candle that has given us this bullish move. You understand? It's the last candle that has given us this bullish move, so which it makes it an order block. And I've told you guys that these order blocks act as what? Support and resistance levels, right? So now let me explain to you guys the what? The fair value gap, right? So the fair value gap looks like this. I told you guys the fair value gap is a three candle formation. Fair value gap.
Excuse me, sir.
Yes.
Our order blocks, like, do they have any specific time frame, or any time frame can work for them?
Okay, it depends on the time frame that you're trading. Are you a scalper? Are you a day trader? Are you a swing trader? Because it all matters.
A day trader.
You're a day trader. So what you want to look at? You want to look at 1 hour order block and 15-minute order blocks. You understand?
Yes.
Yeah, but then for scalpers, you want to look at a 15-minute order block, a 5-minute order block, and a 1-minute order block for entries. So that is it. I hope you guys have understood order blocks. Right? Alright, so let me explain to you guys the fair value gap. So as I told you guys that a fair value gap, let me first remove this. I told you that a fair value gap is a three candle formation. Are you seeing these three candles, these orange candles? 1, 2, 3. Are you seeing them? 1, 2, 3. So the wick of this first candle and the wick of this last candle are going to be our points of interest. Then this third candle, for some reason, it has to leave this gap. Are you seeing the gap between this wick and this wick? So the wick of the first candle and the wick of the last candle that pass through the body of the third candle, they are the ones that give us the fair value gap. So we shall draw a box from this wick to this wick, and that's going to be our fair value gap. From that wick to this wick here. Boom. And that's going to be our fair value gap. Have you guys understood it? So that is the fair value gap. And also this fair value gap acts as what? Support and resistance. So there's an example here. So this is an order block here, right? Because this is the last candle that gave us this movement, right? So when price comes back to it, there are two things that can happen. Price can come and purge it and pass through it and violate it. So when price does that, what do you think happens? There's a theory called inverse theory. It is here up. I hope you guys can see it. Inverse theory. And this theory states that when an order block or any support and resistance level gets purged, what happens? You use that same support and resistance level for some other thing. So for example, if this order block here was acting as what? Who knows what this order block here was acting as? Support or resistance? Who knows? So that it was acting as what? Resistance, eh? Yeah, thank you. So this order block here was acting as resistance. It was acting as resistance in a way that it had to push price further down. But then what did price do? Instead of price coming to it and respecting it, it just passed through it with a big candle. And now this big candle violates our what? Our order block that is acting as resistance. So now if they invert an order block that was acting as resistance, what do you think it shall now act as? Yes, and it's going to be what? It's going to act as what? Support now for price to continue up. Are you guys understanding? What I'm trying to mean is, if this order block was acting as resistance, this order block is acting as resistance, but then what has happened? This big candle here has passed through it. So now, instead of it acting as resistance anymore, it has to act as support. Because now, due to this big candle coming, it is signifying what? Buying pressure. Note, the gray candle is going up, the orange candles are coming down. So for the fact that we've had this gray candle going up, that means the candle that has passed this order block is giving us a specified direction of which we are expecting price to go to. So now in this example, we are expecting price to continue going where? Up, right? We are expecting price to continue going where? Up. Let me first change these candles colors. Let's remove this. So this is it. So for the fact that they've purged this order block here, this candle which is acting as our order block, and it's acting as our what? Support, resistance. So when they purge it and price comes back to it, now we don't want to see price continuing going down. We want to see price closing within the order block. Why? Because of this candle that purged the order block. This candle that has purged the order block is telling us a story, and that story is that price has a willingness to continue going up because it's a thick candle and it has violated resistance. So that means this point of resistance is going to turn into a point of what? Support for price to continue up. So that's why when a candle closes above that order block, just label that order block. If at all they have hit your stop loss, relax. Wait for price to come back to that order block and enter for a trade in that opposite direction. So for example, if we are entering for sales here at this order block before this candle purged, we shall enter there and put our stop loss above or somewhere there. Then this candle comes and takes us out. So when it takes us out, it also violates this order block, right? Isn't it? Yeah, so when it violates this order block, they hit our stop loss. But then when they hit your stop loss, you just have to relax, stay composed. Why? Because price is going to come back. Price is going to come back. Price is going to come back to the order block and retest it for it to go in the opposite direction. So for example here, after this big candle going up, because these gray candles are representing buying, so the candle went up Then what happened next? This candle opens here, then it comes back, it retraces back exactly into this order block. Now when it retraces into this order block, what happens? What are we expecting? We're expecting for price to continue further pushing up, because now this was a retest for us to enter in for buys from this order block that is acting as support. Remember, this order block here was acting as resistance, but then since they passed through it with this black buying candle and hit our stop losses, so we are anticipating that it is going to act as what? It's going to act as support. It's a resistance order block, but then when they pass through it, it's going to act as what? Support. So when price comes back to it, it has to act as support for price to stop there. And you can see in this example, price stopped here. Then what happened? Price pushed up further. I hope you guys have understood that, right?
Yeah.
Has everyone understood?
No.
Yes, where haven't you understood? I explained for you once again.
Good evening, bro.
Good evening. How are you?
Just I came here, so I didn't give anything about that. Yeah.
Alright, so what I was trying to explain is support and resistance. But then if you can see here, earlier today we've said that, when we started our presentation, we've said that we are going to talk about elements of an A plus trade setup, right? And what did we say? We said that elements of an A plus trade setup we have, number one is trend.
Yeah.
Number two is support and resistance. Number three is risk management. So we came to trend. Now we are talking about trend. We say trend has two trends. We have a bullish trend and a bearish trend. And bullish is going up, bearish is going where? Down. Then we came to support and resistance, which is our number two. And we said support and resistance, support is going to act as the floor, resistance is going to act as the what? Ceiling. So we gave an example that if you jump from the floor to the ceiling, what happens? You will touch the ceiling and it shall push you down. Why shall it push you down? Because of gravity. And now gravity is acting as what? Resistance. Then you come back and fall on the floor, which is acting as what? Support. Yes, so we gave examples and we say that for this case we are going to use fair value gaps and order blocks to act as support and resistance. You understand?
Yeah.
So here in this example, I came now to explain and illustrate the order blocks and fair value gaps. And then I said that a fair value gap is a 3 candle formation, while an order block is a 1 candle formation pattern. So for an order block is literally a candle that has, an order block is an opposite candle that is going in an opposite direction that has led to the distribution of price in the opposite direction. It's the last candle. So for example, in this example here, this gray candle, the gray candles are representing what? Buying, isn't it? Then the orange candles are representing what? Selling, right? So this gray candle here is the last candle that has given us this opposite movement, right? For sales. So this candle is going to be an order block because it's the last candle that has given us all this selling pressure in the market. So we label it as our order block, yes? This candle here, this gray one. So you label it as an order block.
Alright.
You understand, right? Yeah, so now when you label it as an order block, you want to wait for what? Price goes down, then you wait for price to come back here. Now remember, since it is a buying candle, in this case it's going to act as what? Resistance. Because now it is the last buying candle that has given us selling. So we expect that if price comes back to it, we are going to continue what? Selling, isn't it? So that means it has to act as what? Resistance. This order block here. It has to act as what? Resistance. But then, and resistance means that price is going to come back to the ceiling and gravity shall pull it down. But then what happens? Instead of this order block acting as what? Resistance. What do they do to it? They come and they pass through it. Now when they pass through it, that means they have shown unwillingness for this order block to act as what? Resistance, for price to continue going down. Hope you're getting me, right? So, and I've told you guys that if I told you I had entered for sales on this order block, because it's acting as your resistance, and you had put your stop loss above here, and they have hit your stop loss, you just have to stay composed, you have to stay chill. Why? Because now you have the analogy that if price takes out a resistance level, that resistance level becomes a what? A support level. So now this order block was acting as resistance, but then since they have purged it with a big candle, this big candle alone here is showing us that price wants to do what? Price wants to do what? To buy, to continue buying, right? This one, this candle that has purged our order block. So that means this order block is going to act as our support. If price comes back at any other point of time, we are going to be buying from here. And what does price do? It opens and it comes down exactly in the order block, and we take our trade for buys and it continues in the other direction. But then you're using the theory of inverse. You understand? Yeah?
Bro, just 1 minute.
Yes.
After this candle, the big candle for buying candle.
Yeah.
The next candle is for selling or for buying.
You're saying this candle. You're saying this one.
Yes, the middle one.
This one is buying. It is the
Buying.
candle that has retraced.
Okay.
This candle here is the candle that has retraced back into the order block to give us an entry. Yeah?
Okay.
Yeah, for buying. So it can push up to down, but then sometimes it will stop at the fair value gap, then the body will close in the order block. Now when the body closes in the order block, it gives you confirmation that price is getting support from this level to continue up. Yes, have you understood?
Yeah.
Has everyone understood?
Sure.
Everyone has understood, yes?
Yes, sir.
Alright, so now that is the order block. Then now if we go to the fair value gap, I say that the fair value gap is a 3 candle formation pattern. That we are going to look at now these 3 candles here. These orange candles, these 3 orange candles, right? Are the ones we are going to look at. This is the first candle, this is the second candle, and this is the third candle. And what did we say about them? We said that a fair value gap is the space that is left in between the middle candle, which is the second candle. And that space is called an inefficiency. And how can we know that there's a space there? We look at the wick of the first candle and the wick of the last candle. Now, if these wicks do not overlap themselves to close this gap or this inefficiency, and they leave this inefficiency open, we call that a fair value gap. Why do we call it a fair value gap? Because at any time in future, this fair value gap would want to be balanced. Are you guys listening? Anytime in future, this fair value gap shall be what? Balanced. So we come and we label our fair value gap from the wick of this first candle to the wick of the third candle. And then we put our fair value gap there. I think you can see from the wick of the first candle to the wick of the third candle. Have you seen that? From this wick of this. Now these lines that you see are called wicks. These ones are called what? Wicks. These ones are the body. The color orange is the body. This black line is the wick. And what does this wick signify? It signifies its price. It signifies that price pushed down but then closed back with its body. I understand it. Is everyone understanding? Yes?
Yes.
Yes, so now that's our fair value gap. And we've said that the fair value gap acts as what? It also acts as support and resistance. So in this case, this fair value gap here is a what? Sell side imbalance. It is a selling fair value gap, which means that this fair value gap has to do what? Give us or act as resistance, isn't it? So that means we're expecting that price would come back to fill this fair value gap and continue pushing down. But then what happens? Still, price came and purged that fair value gap with a big candle, this big candle that you're seeing here. It purged the fair value gap and the order blew. So even though you had your stop losses here and you had taken your trade from this fair value gap, this big candle alone shall take out your stop loss. So now what happens? When this big candle comes and does not respect this fair value gap, what do? We look out for the inverse theory. You don't just run away from the markets, you wait. So now, since we know that, okay, now the markets do not want to go down, they want to go up. Or maybe it is a manipulation that has been made. So now, here at this fair value gap, we are supposed to look for what? Resistance, so that price can continue going down. But then what happens? They purge that level with a big, huge candle. Now, after purging that level with a big, huge candle, you look for the inverse theory that states that now this fair value gap that was acting as resistance is now going to act as what? Support. So now that means at any other point, if price or any commodity comes back to this fair value gap, we are buying, isn't it?
Yes.
Yes. Now, for example, in this scenario here, in this scenario, we are having this candle that came back to retrace in the order block. It came and it pushed up to this fair value gap. You can see that wick. That wick closed in the fair value gap and then it swept up. I hope you guys understood that. Right?
I have a small question.
Yes, what's the question?
How do you react to the price is good, just stop it, the fair value up, and then you in the original direction?
Pardon me, your volume is low. Your volume is low. Pardon me.
Like, we determine that let's go trade in the fair value up and then continue this original direction, or it is actually going to go through the fair value gap and then we tap into the order block. Then you continue to the direction.
Okay, what we are going to do is this. Man, you text me, you text in the comment section, you write your question there. You write your question, I read it. Write your question. Write your question there. Mr. Lin, I'm seeing your hand up. Yes?
Bro, my question is,
Yes.
I thought that if the market is going down,
Yes.
we cannot take. That is my question. I thought that when the market is going down, we cannot take the value gap of selling, yet we want to go to the buying section. Yet we want to go to the buying time. Is it true or not?
Pardon me again.
I mean, I thought
Mm.
that when the time is selling time, we
Yes.
cannot use selling time fair value gap. Is it true or not?
It is not true.
Why?
It's not true. Has everyone understood what Mr. Lin is asking? You first repeat that question again. That inquiry.
I mean,
Yes.
when it's selling time,
Yeah.
and you see that the fair value gap. No, I mean when you see the fair value gap on the selling time.
Yeah.
So can you take it or not? Or we can use it or not?
You see, when you figure out that there's a selling fair value gap, for example, this fair value gap here. Let's get my arrow. So now, for example, this fair value gap here, if at all it was selling time, of which this is a selling setup, you would take your trade here, right? When price taps it, and put your stop loss above here, right? And wait for price to go down, because now this is a resistance level, isn't it?
Yeah.
But then when a big candle comes up like this and sweeps your stop loss out and sweeps this order block and violates the fair value gap, what comes in your head? What comes in your head has to be that this big candle is telling us a story, and the story is that price wants to run up. You understand? So what you do, instead of going to cry, you sit and you wait. The same trade and the same risk management ratio, wait for one of the drivers in the race, which is going to be now these candles, because now they're the drivers taking price up. You wait for them to come back and pick you up here at this fair value gap to go with them. You understand? So that means this fair value gap here is going to act as what? Support now. It has to act as support to stop price from continuing going down. Because now this big candle has already told us a story that it wants to go up, or the market wants to go up. So what you want to be doing is you want to be looking for friends that know how to analyze maybe Nasdaq, maybe Euro USD, maybe USD JPY, any of them, and tell them to wait or and give you a signal from this fair value gap that is going to turn as what? Support instead of resistance. Now, I hope you understand now.
Yeah.
Yes, exactly. So that is the fair value gap. So for those that have just arrived, we've been talking about elements of A+ trade setups. And we said point 1 is you need to know the trend. Point number 2 is you need to know the support and resistance. Point number 3 is you need to know your risk management. And then we've said that number 1, which is trend, we have what? The bullish trend and the what? Bearish trend. And I explained that the bullish trend represents buying, while the bearish trend represents what? Selling. Another word or another term to represent bullish is up. So when you talk of the bullish trend, we are meaning uptrend. And the bullish name comes in from the bull. A bull is an animal whereby when it sees red and it's going to fight or attack, what does it do? It hits you with its horn and taking you up. It hits while taking up. It attacks while taking up. It attacks with its horns. It uses its horns for protection. And that's the bull. That's where the bullish thing comes from. Then the bearish comes in when you like bears a lot. When you like trading bears, or rather when you like bears as toys, as dolls, as anyway. So now a bear or bearish market means price is going down. That's another word for bears. So now that means that you want to differentiate yourself between these two. You want to know the trend so that you do not fall in the trap of misaligning what? Misaligning what? This time and the cycles that I've given you about the fair value gap. Then, point 3 is risk management. So I furthermore talked about risk management, and I say that risk management is crucial. And how is risk management crucial? We've said that risk management is the backbone of a trade setup. If you do not know how much money you're going to risk and how much money you're going to gain, then you're gambling. What I'm trying to mean is risk management is the estimated amount of money that you're willing to risk in order for you to do what? Gain a profit. So that means if you're not ready to gain a profit, you're just lying yourself. But then if you're gaining to get some small moves, then you have to be so critical. So risk management is the backbone to the trading setup. You have to know how much money you're going to risk and how much money you're going to receive. And I've given you guys some examples of risk management. We have 1-to-1, we have 1-to-2, 1-to-3, 1-to-4, and 1-to-5. And what does that mean? Who knows what it means?
I was about to ask that.
Pardon?
I was about to ask that.
Yes. Now, I told you guys when we were talking about risk management that we're having two things, right? We have risk to reward ratios. So now what does a risk to reward ratio mean? A risk to reward ratio means that how much money are you willing to deposit on your affiliate program, rather on your broker, you understand, on your trading account. So if you have a risk to reward ratio of, let me give you the examples of risk to reward ratios. We have 1-to-1, we have 1-to-2, we have 1-to-3, 1-to-4, 1-to-5, 1-to-6, 1-to-7, 1-to-8, 1-to-9, 1-to-10, up to 1 to whatever. There's also 2-to-1, there's 2-to-5. It just depends. So those ratios are representing, what I'm trying to say is you're risking $1 to make $2. That is 1-to-2. That is the risk to reward ratio. If I talk of a risk to reward ratio that is 1-to-5, that means I'm risking $1 to make $5. If I talk of a risk to reward ratio of 1-to-1,000, that means I'm risking $1 to make $1,000, which can't happen and it has never happened. But then that is risk management for you. So it has two aspects. It has risk and reward. So how much money are you willing to risk and how much money are you willing to receive? So that's back. It takes us back to the schools that we studied. Risk to reward, whereby they told you that you have to risk something in order for you to get a reward. Completely. So that is it. Has everyone understood?
Bro, a question.
Yes.
What if I make my analysis and I enter the market, I put my stop loss and my take profit, and the market didn't eat my take profit? What should I do?
If market does not hit your take profit,
Yes.
and it's still moving,
And it's still against me.
you close the trade. That's the advice I can give you. Yes, you close the trade. Unless if you're going to swing trade. But what are you trying to mean? You're trying to mean that if price, instead of hitting your take profit, it comes close to hitting your take profit, then it comes down.
Yes.
Yes, you close that trade. You close it.
Okay.
Yeah. So I'm seeing a question here from Phoenix. Which time frame can we get a valid order block? In which time? In which time frame can we get or find the FVG? So I've told you guys that there are three things. You have to figure out which type of trader you are. Are you a day trader? Are you a swing trader? Or you a scalper? So for scalpers, if you want order blocks or fair value gaps, you want to start from what? 15 minutes. You want to get the 15-minute what? Order block or fair value gap. You get the 5-minute order block or fair value gap. Then you get the 1-minute order block and fair value gap. That is for scalpers because we are in and out. Then for day traders, you want to get the what? 1 hour order block and fair value gap. You want to get the 15 minutes order block and fair value gap. And then you want to enter your trade on the 5-minute order block or fair value gap on the 5-minute. That's where I'm going to stop because I doubt that I have swing traders here or anyone that wants to swing trade. I hope you guys have understood that, right? Yes, have I made myself clear with the question?
Yeah, but I mean, you said a day trader he has to use 1 hour.
Yeah.
For me, I was using 4 hours.
Yes, 4 hours is also okay. But then you have to be patient. Yeah.
Okay.
So Phoenix, did I answer your question? Okay, so as I've been telling you guys that today we are going to repeat this lecture, which is elements of a plus trade setup. And we've talked about trend. You have to figure out your trend, whether it's bullish or bearish, support and resistance, and these support and resistance levels are acting as the floor and the ceiling, in a way that when you jump from the floor, you hit the ceiling pushes you down due to gravity, and where do you fall? You fall on the floor, right? Then point 3 is risk management. And I hope you guys have understood. So now let us go to the charts and we see what we are trying to talk about. So let us go to today's chart in particular. So let me bring the chart. Let me bring the chart. Where is it? It's the silly chart. Come on, Nasdaq. Come on. We need this chart. Come on. Alright, so in this case, which trend is this? Which trend is this, guys?
Downtrend.
Yes, it's a downtrend. And what is another name for a downtrend?
Bearish.
Yes, bearish. So it is a bearish trend or downtrend. And that means whenever you're in a downtrend, what are you expecting? You're expecting to sell, right? So that is our trend. So now after establishing our trend, what do we have to do? We have to look for our support and resistance levels. So in this case, we have to look for order blocks on which we are going to do what? To sell. So now in this case here, I told you guys, what did I tell you guys? For day traders, you want to go to 1 hour and figure out your order block, right? So this one is our order block here. This candle. Are you seeing it? This black candle here. Are you seeing it?
Yes.
So you mark it high and you mark it low and you wait. So you can see what happened. Price passed through it, isn't it? After passing through it, now it has to act as what? Resistance. After passing through it with a heavy candle, they always pass through them with a heavy candle. So they pass through it with a heavy candle. What does price do? Price goes back to that order block, isn't it?
Yeah.
This is what I'm trying to talk about here. Let me come. Are you seeing? This is our order block. This is the candle that has formed the order block. This candle here. So you mark it high and you mark it low. You pull it. Then price, what does price do? It passes through that order block with a what? With a heavy candle. Now this order block was acting as what? Support, but now it's acting as resistance. So now you wait for price to come back and retrace into it. And then what do we do from there? We sell. So you sell there if you're a day trader. You sell there because this is a 1 hour chart, so that means each candlestick is 1 hour. So you're going to sell for 1, 2, 3, 4, 5 hours until this liquidity. So that means for 5 hours you're holding this trade. You understand? Yes?
Yes.
Yes, that is it. That is an example. So now that is point 2. Point 1 is you figure out your trend. Are we bearish or bullish? After figuring that, you want to look for your order blocks and fair value gaps as support and resistance levels. So now in this case, we've used A and order block as our support, as our resistance level. And price comes back to it and you'd like to take your trade there with risk management. So even though you're risking $1, you're going to make 5. Maybe you're going to risk $1 and make 10. Maybe you're going to risk $2 and make 20. You understand? Has everybody understood this?
Bro,
Yes.
in this trend, no need to use fair value gap.
You can use fair value gaps.
So in this trend, you put it where?
Let me go down and I show you. Alright, let us look at today. We look at today, right? We look at today. Me, I told you guys I'm a scalper. So we mark out today, which is 1800 from 1830. So now, from today, what is the trend?
Uptrend. Trends.
What is the trend today?
It's like an uptrend.
Yes, it's an uptrend. You can see it, right? So now when you figure out that we are in an uptrend, what do you want to be doing? You want to be what? Buying, right? Yes? Exactly. Now if you want to be buying, now this is our trend. So what are we looking for? We are looking for support and resistance levels, isn't it? Right?
Yes.
So but as I told you guys, let me give you another disclaimer. You have to wait for time. We are going to explain time in the forthcoming what? Boot camp. So me, I like looking at 9:30. That is when I start looking for my trades. From 9:30. So that's 9:30. From 9:30 to around 11:30 to around 12 actually. I must be done with my scalp. because I'm a scalper, so I must be done by that time. So now here, this is the 5 minute, isn't it? Right? So we go to 1 minute. So we figured out that our trend is bullish. So now we come to 1 minute. So inside here, in between here, we are going to look for a trade, right? Here. And what is going to be our trade here? Like, there's this. Remember, you always want to look for market structure shifts, right? So we have this, they take out buy side liquidity here, and they take out sell side liquidity down here. Are you seeing that? And then what do they leave? Are you seeing the fair value gap? Here.
Yeah.
So they leave that fair value gap. And this fair value gap has to act as what? Resistance for price to go down, right? So what do? You come here and you enter for your trade. Exactly there. You put your stop loss above there. Remember, I'm a scalper, so we are not taking long here. Then you put your trade, you leave it to run. And they hit your TP. Just like that. You understand? Have you seen that example? Now after there, you're waiting for another shift. So we remove that trade. You're waiting for another shift. And another shift will come when they take out this downtrend. Here.
So how many times we have trade in a day?
May I only trade 2 times a day? 2 trades.
Yet you are scalper.
Yeah, 2 trades. You have to have discipline. Doesn't mean that because you're a scalper you have to take 100 trades. No, I take 2 trades. So another shift will come when they break this trend, this cut down trend here. You can see that cut down trend there, right? Yes, that bearish trend. So now, how do they break it? Are you seeing this last high here? This one. So when they break it there, they give us a market structure shift here. When they break it there, this candle that has gone through this trend, it leaves what? Are you seeing the fair value gap?
Yeah.
Here. And now that fair value gap has to act as what? Support.
What?
Yes, for price to go up. So what do? I come back here and I just enter for this. I put my stop loss below there. Then I target this high here, where the trend started from. There. And boom. And you're done for the day. Are you seeing that? Yes, simple and clean, and you're out. You're done for the day. You no longer want anything. You're not demanding anything from the markets. So I hope I've explained to you guys how this works.
Thanks, bro.
Has everybody understood? Even the beginners, have you understood? Alright, that's nice. Alright, so do you have any questions before we close this class? Which sessions do you trade? I trade only New York. I trade New York session. This is New York session here. I trade New York session. Why? Because it has big candles. It has a lot of liquidity. That's why it has big candles. Yeah.
So, bro.
Yes.
The only problem I have is time in the markets.
Alright, we are going to handle time next week. So don't miss.
Okay.
Yeah, next week. Yeah.
Because that's the only problem I have.
Okay, we are going to handle time next week. Which model do you use? I use time and price. That's my strategy, but now I don't understand when you talk of model. Like, what you're trying to mean the strategy? I use time and price, but I mix in price action and ICT concepts. You understand? On the price side, I use ICT concepts and price action. So actually, the fair value gaps and order blocks are from ICT. The market structure shifts are from ICT concepts. Yeah. So the entry, I like using fair value gaps. I like using fair value gaps over order blocks. You know why? Because fair value gaps shall always be tapped because they are the first levels. Order blocks are rarely tapped. Yes, that is it. So I hope you guys have understood a lot from this lecture, and yeah, I want to close it off, and I hope you guys have understood. Any questions before we close? Yes, Lubega?
No, sir, I have no question.
Alright. Okay, Bertram, I appreciate you saying thank you a lot, bro. I appreciate.
Okay, thanks, bro, man.
Alright, you're welcome. So let us pray, we close it off. Mighty Father, we thank you for the gift of life. We thank you that we are here today. We thank you that you've given us knowledge, wisdom, and understanding to break down these markets. And we thank you for the love that you've given us, that we are still alive, Lord Father. That we still have hands, oh Lord, that can press buy or sell. That we still have heads and the brains that can still understand these concepts, Lord Father. We pray for protection as we are going back home, as we are going to do maybe other things, and we pray that each and everything that has been taught here is learned and is practiced. In the mighty name of Jesus Christ we pray. Amen.
Amen. Thank you so much.
Alright, you're welcome. So today's session is done. Thank you so much for attending. See you guys tomorrow in the morning session, right? I'm really so tired.
Alright, thank you, sir.
You're welcome. Okay, good night.